This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris. I'm with Nelson Financial Planning on Mondays through Fridays, but on Sunday we're sitting here in the iHeartRadio studios and coming to you with the program that is, in fact, Central Florida's longest-running radio program, started 30-plus years ago by my now late father, Jack Nelson. The tradition continues with me, yours truly, Joel Garris. So on the program, as we have each and every week, we talk about a variety of events. I've got a couple of things that I've got teed up already on the program. First and foremost, we're going to talk a little bit about what negative savings rate or negative yields really mean from a savings perspective. Had a fascinating conversation this past week in the office with a client who grew up in Spain, still had a savings account over there in a bank, and proceeded to go back last month, as he typically does every couple of years, and checked in on his savings account, and surprise. So we'll talk about that and how that relates to the bigger picture, particularly the bigger picture on interest rates as well. Also, we'll touch upon the latest proposed regulation that helps moving your 401k. Perhaps, in fact, it may get easier. Let's hope so. Oftentimes, what we see in the business is that plan custodians, plan fiduciaries, they'll make it as easy as possible to move it into an IRA with them. But heaven forbid if you plan to move that money to someplace else. The process can, in fact, be quite cumbersome. And then lastly, we'll hit upon a little bit of the cannabis story. That's a story that continues to dominate the headlines. All this pot investing conversation. We'll try and go over the landscape of where we are and where we see that happening. So that's the overall perspective on what we're going to tackle on the program today. So let's begin. So this past week had a conversation with somebody, as I said at the beginning of the program, that had a bank account over in Spain. That's where he grew up. And so every couple of years he winds up going back. And when he goes back, he likes to check on how much on how his bank account is doing there. And so he went back and learned that he, in fact, had less money in his bank account. And I'm not talking about based upon the currency conversion or anything like that. He just simply had X number of euros in the bank account when he looked a couple of years ago, and now he has less than X euros in that bank account. And the reality is, this is the effect of negative interest rates that we are seeing in different parts of the world. And this conversation about negative interest rates is a fascinating one, because we hear a lot about a lot of rumors, a lot of conversation, certainly on the internet, where there's talk of, the U.S. dollar is in decline, or the U.S. Treasury, it's just no longer going to be the world's reserve currency. And folks, we're just such a long ways from that when you stop and and understand the implications of just how impactful negative rates are in the many countries around the world that still have negative rates. What that means, as my client saw firsthand, is that you wind up with less money. And again, not talking about inflation, not talking about the currency conversion. We're just straight talking about, I had X euros a couple of years ago. Now I have less than X euros as a result of the negative interest rates. You hear about it. You understand in academics how it works, but it's a whole nother thing to see how it plays out in terms of real dollars. What was also a kicker, because we were talking about it, what was also a kicker is when he went into the bank to ask for a printout of what was going on in the account. He just wanted a printout, just wanted that baseline information, like an account statement. They were going to charge him €6 for a printout of the account that, in fact, had gone down in value simply by just sitting there. Don't ignore. We hear a lot of conversation about the yield curve and how it's getting inverted and all that kind of stuff and in this country, and you really can't put that much stock into that these days, especially when you start looking at interest rates around the rest of the world. And that's just one kind of fascinating anecdotal study or anecdotal conversation that really brings it home in terms of what it really means. 2 years ago, I had X euros. Now I have less than X euros. Because with negative interest rates, it's a subtraction from my balance. Nothing to do with inflation, nothing to do with currency conversion, just a straight subtraction out of the account. That's so perverse. I mean, imagine an economic system where it does not make sense to save money in a savings account. In essence, what the countries over in Europe are trying to do is they're trying to get people, to force people to invest their money, to spend their money, and thereby help improve the overall economic condition. The problem is that when you're going negative on your interest rates, you create a lot of fear and concern that makes it even more difficult for folks to want to employ their capital. That's why, in a lot of ways, over in Europe, they have really yet to recover from 2008, still struggling with incredibly low and negative interest rates and the effect that has on it. So as we look around and compare sort of where we are versus the rest of the world, it is clearly good to be situated in this country. That is for sure. So some interesting actual effect of what the negative interest rates really mean. People really have a hard time conceptualizing that when we talk about that, but there's the real life example of exactly how it all works. You wind up with less money. No questions at all, which is crazy, again, when you stop and think about it, because it's supposed to be money that's just sitting in a savings account. You certainly couldn't imagine that would go down in value. In many places around the world, that is, in fact, exactly what is happening. So some interesting perspective on exactly what the effect of the negative interest rates are on your savings account. Pretty dramatic, pretty big problem over there in Europe. We will continue the conversation here on the program. Stay tuned for the next segment. We'll talk a little bit about how moving your 401k may, in fact, finally be getting easier here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Dollars and Cents with Joel Garris of Nelson Financial Planning. On this segment of the program, we're going to talk a little bit about a proposed regulation courtesy of the folks in the Labor Department that may, in fact, help you to preserve and protect your 401k by making it easier to move that 401k when you leave your employer. Right now, the situation is such that particularly on small balance 401ks, where maybe you've only been there for a year or two and haven't accumulated a whole lot, that's where the most amount of damage occurs, in that the account gets forgotten, or worse yet, the account gets automatically distributed out to you. Because under the rules, typically employers have some options in terms of forcing your hand with that old 401k. For example, if your balance is under $5,000 in a 401k and you leave that employer, the employer can choose to move that over to an IRA with the custodian of the 401k. And the reason they want to do that is because there is a cost associated with each employee, particularly when it relates to a 401k. A 401k plan has a lot of an annual government filing called a 5500 that has to be done, and the cost of the testing that also goes with a 401k, where they have to test to make sure that the folks that are taking advantage of the 401k aren't just the high income earners for that company. The point of the 401k is for it to be available across the board for all employees. And there's actually some testing that happens each and every year on every 401k that determines whether the usage of that 401k is, in fact, consistent across the board for all employees, regardless of how much money they make. And if it's just an overweight to the high income earners, then that's when the plan is out of regulation, has violated the rules. And oftentimes we see when high-income earners who have put too much into the 401k, and particularly a 401k that doesn't meet the tests, wind up getting a distribution back from that 401k because it failed to meet the rules. And so when you get that distribution back, you've got to report and pay taxes on that. So each time you have an employee sitting there with a small balance, there's a calculation that needs to be made that it throws off the net results on those numbers when you look at the ability of folks to participate and contribute sort of across the spectrum of employees. So one of the things that employers are more than happy to do once you leave is they want to get that off the books. And so if it's under $5,000, what they can choose to do is they can shift that over to an IRA automatically, regardless of whether you opted to it or not. They can simply move that off the books of the 401k and move it over into an IRA. The situation gets even more dramatic if your balance is under $1,000. If it's under $1,000, the employer, in fact, can simply choose to just issue a check for the full amount. The problem with that is that anytime that is done, right, then that's income plus a tax penalty. So that's a very steep cost when that happens. But if employees sort of forget or don't bother or don't go through the hassle and the headache and all those kinds of things, then you wind up easily becoming subject to this. And we see this on a regular basis. When we help people roll over their 401ks, doesn't matter whether it's $1,000, $5,000, or $100,000, there is a process involved. And even the easy ones typically require a 20 or 30-minute phone call just to go through the process and the procedure and the verification and the reading of the tax notices. All of that takes time, which the average layperson is just going to kind of throw up their hands on and say, you know what, I'm just simply not going to bother to do this. And then that's where the problem particularly comes into play, particularly for those smaller accounts, is you wind up getting kicked to the curb by your employer or by your ex-employer with respect to the 401k, particularly dramatic if you've got a balance of less than $1,000. That's just going to get paid out, and then you have to pay taxes and a penalty on that. So the process of having to, as an employee, go through the process of making sure that that money winds up where it needs to be, that does take time, that does take effort, and you do have to figure it out. And what we've observed is that more and more trustees, particularly on larger balance 401ks, they like to throw up as many hurdles or roadblocks as possible, because the longer they keep the money under their umbrella, the more they make in the term of fees, because all of those accounts, all those funds under a particular 401k custodian, there's all fees on an internal basis or maybe even an external basis on on each employee, and so consequently, they've got sort of a perverted incentive to, hey, if we hold on to this money longer, then we're going to make more money than what we would otherwise. So a little bit of an odd incentive to, well, you've got to get this form, you've got to get that form, you've got to call, you've got to do this, that, and the other thing. That's a good way to kind of slow down the process. So it is a bit convoluted, particularly for those smaller balance ones that often sort of really get lost in the shuffle if they're getting moved over to an IRA or simply getting cashed out. So obviously the folks in Washington and the Labor Department in particular are quite concerned of this, because it goes to the whole crisis of retirement that we have in this country, which is that, generally speaking, a lot of folks haven't really saved that much for retirement, and so consequently, that's a real problem. When you hear the statistics of how little has been saved on average, then the folks in Washington obviously look at that, and rightfully so, try and figure out a way to encourage better behavior. One of those ways to get better behavior is simply to make it easier to deal with your 401k when you leave your ex-employer. So the regulation proposed by the folks in Washington, the Labor Department specifically, is that employees can have their employer automatically roll their 401k money over to an IRA. And so the IRA, when they leave the job, the IRA could then be automatically transferred to a 401k at their next employer. If the new employer doesn't offer a 401k, or if the employee perhaps doesn't find the next job right away, then the money could certainly stay in the IRA. So it's using IRAs as a way to encourage folks to ultimately deal with their money and not leave it behind at an ex-employer. See, a lot of things happen along the way the longer you leave that money with an ex-employer. The plan may change. It may have a new custodian. It may have a new range of funds. It may get merged into another one, and you wind up with investments that aren't anywhere near close to what you had originally. The longer the period of time goes that you leave your money at your old employer, the greater the likelihood is that you're simply going to lose all level of understanding and oversight over what's going on with that. Today, you can certainly take control of that, but it is a process. Hopefully, with these new rules, we will see a little bit of an improvement in that process. When we get back, we'll wrap up this part of the conversation and continue on here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents, Central Florida's longest-running radio program, talking a little bit about a proposed regulation from the Labor Department that hopefully it'll become the standard that will, in fact, help with making it easier to move your 401k. Far too often, there's paperwork, there's a process. The rules that are in play actually encourage the employer to kind of kick you off the rolls sooner rather than later, particularly if you've got a balance less than $5,000. And that contributes to a lot of people sort of losing track of, or in fact, just taking a cash distribution on that money. When they do that, that means that they're going to obviously have less money for retirement. The process of trying to simply roll that over to an IRA can, in fact, be quite a cumbersome one. Sometimes you'll be able to do it online, or sometimes you'll be able to do it with a phone call. But even those processes take a fundamental understanding of how that's supposed to work. For the average layperson, that can be a difficult process. For folks in our office, I mean, we do that pretty much every day or every week at the very least. And so that's a pretty straightforward process because we've done it a gazillion times before. But for the average person doing it once or twice in the course of their lifetime, well, that's a different story. And so there's a process there that takes a while to get through. What also folks can encounter is a process that is, in fact, much harder, meaning, there's paperwork, and so this phone call today, it'll just result in us mailing you out the paperwork, and then once you get the paperwork, then you've got to fill it out, and the paperwork we're going to send you is 25 pages long. Good luck figuring that out. That's the landscape. That's the environment that we are in now. Very difficult for a multitude of reasons, but they primarily encompass two, which is that the current investment manager wants to keep the money as long as possible, but yet, number two, the employer wants to get you off the rolls of the 401k to reduce their costs. So you can see where there's an incentive to delay and to drag the process, particularly on the part of the investment management company that is the one that is in control of the 401k. The longer you can keep the assets there, the more money the 401k manager or the investment manager makes. All of that potentially subject to change, which I think is great because anything that makes that process easier is always a good thing. The proposed rules, not quite the rules, but the proposed rules by the Labor Department would basically allow folks employees who have left their employer to automatically be able to roll over their 401k money to an IRA. When you do that, that's a non-taxable transaction, and that would happen automatically when you leave the job. That way, you've got your money, you control it, and it's in an IRA. When then you go to the next employer, you can take that IRA money and automatically transfer that to the 401k of the next employer. If the next employer doesn't have a 401k, then it's perfectly fine to leave the money in an IRA. After all, that's a perfectly acceptable way to hold retirement dollars. So an emphasis on portability as a result of these new rules out of the Labor Department. Obviously, anything that makes that process easier, particularly when it relates to your money and being able to control it, we're big fans of that. So hopefully that proposal, in fact, becomes a rule. And that would certainly make life easier in terms of being able to keep track of and bring your 401k with you. Much like when you left your prior employer, you took the pictures of the kids and the dog and all that kind of stuff. Why wouldn't you at the same time also take your money as well? So if you've got an old 401k or an old balance sitting with a prior employer, one of the things that we would encourage you to do is to take a look at that and really try and get with someone to help with that process of getting it out of the hands of that old employer. If you're working with someone, we would encourage you to go to them. If you're not working with someone, or if who you're working with doesn't want to help you on it, then certainly give us a call at Nelson Financial Planning this week, and we would be happy to assist. We do that on a very regular basis and know that process quite thoroughly. It can be a time-consuming process, that is for sure. Speaking of time-consuming processes, the tax law and preparing taxes is also quite time-consuming. And so some of the numbers have started to come out for the most recent tax season that was just completed. And perhaps one of the biggest changes, of course, is that higher standard deduction and the effect that that has on people's ability to deduct the types of things that they traditionally were able to deduct before. Well, some of the early numbers out really suggest that it has been pretty dramatic. As of 2017, so the 2017 tax return, which would be the one prior to the increase in standard deduction, there were 34 million Americans who claimed the mortgage interest deduction on their tax return for the year 2017. In 2018, again, the move to the higher standard deduction, that number dropped all the way down to 14 million. So we went from 34 million down to 14 million. Folks, that's a pretty dramatic change that is in line with the expectation that as you go to a higher standard deduction, in theory, it's a simpler return because you don't have to sit down and figure out all that stuff. But at the end of the day, now 65% of the people who were taking the mortgage interest write-off as a specific deduction on your tax return are now no longer doing that. So what's interesting about that, particularly as you look at these numbers, I mean, nowadays, out of the total people who actually file a return, you've got basically about 15% that is, in fact, still taking the mortgage interest deduction out of all homeowners. So not just looking at out of all tax returns, but out of all homeowners, you're looking at a situation where only about 15% take the mortgage interest deduction. So one of the things that brings up in terms of conversation and planning is, does it make sense as much as it might have in the past to continue to have a mortgage, particularly a mortgage in retirement? And to the extent that the tax rules are what they are right now, I think it does reopen the conversation of whether it makes sense to have a mortgage or not. Certainly if you're in the 15% of homeowner population that still is writing off their mortgage interest, well, then that's fantastic. That's great. And obviously that is helping you to reduce your taxes. But for the other large portion that even the portion that was writing their mortgage interest off that isn't, I think it may make sense, particularly if your interest rate is high, to kind of revisit that conversation. It certainly is a big change in the tax law, and it certainly does have ripple effects on how you approach your investments and your assets and your debt or your liabilities, because now no longer you're not able to write that interest rate off. Of course, the reality is, too, that unless you've been living under a rock, so to speak, that for the past several years, it's been historically low interest rates. So what you should have done at some point over the course of the past several years, if you had a mortgage, was to refinance to some kind of a fixed rate mortgage, because then you would secure a very low interest rate for an extended period of time, well, for the remaining part of the loan. So anyway, some things to think about, particularly as it relates to mortgage interest and the latest stats that are out there. We will slide to a break. When we get back from the break, we'll shift gears and talk a little bit about pot. So that'll be an exciting subject, or maybe a relaxing subject, depending upon your perspective. When we get back here on Dollars and Cents, this is Joel Garris, Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
And this is Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. On the program today, we've certainly covered a lot of territory, some interesting new proposed rules out of the Labor Department that would make moving your 401k once you left your employer a little bit easier. That's always a good thing, having better portability with your money. After all, it is your money, so why wouldn't you want a higher level of portability? Started the show off with the story of what the real impact of having negative savings rates really is. Folks over in Europe are confronting that on a regular basis. That's a pretty tough economic hole to climb out of. When you put X number of euros into a bank account and then over the course of a couple of years, you then double check it, and lo and behold, you've got less than X. That's not good. That's the definition of negative savings rate. That's a tough situation to be in, particularly over in Europe. That is for sure. That's a pretty dramatic. And then we were given a little statistics on the mortgage interest deduction. One other interesting tax statistic that came out recently was the rate of audit. The rate of audit has fallen dramatically over the course of the past 7 years, from 1 out of every 91 returns to now 1 out of every 169 returns. So your odds of an audit have gone down quite dramatically. That doesn't mean that you should push the line more, simply because much of what happens with the IRS is a matching up of the numbers that they get versus what you reported on your tax return. Remember, the vast majority of stuff, the vast majority of income items these days, the IRS gets a duplicate copy. So before you hear those numbers and say, oh, well, I'm going to take a greater risk on my tax return because the risk of audit has gone down, be careful about that, because there's a lot more matching of the information using the computers that the IRS has. And the fact that pretty much everything you get these days is copied to the IRS. So at the beginning of the program, we mentioned we were going to talk about this. We'll talk about, we'll now shift gears and cover the pot story a little bit. It's certainly one that we've hit from time to time. Wanted to just kind of give some additional thoughts on that particular topic, because it continues to be a very interesting story. And it seems to be an industry that is very much full of stories indeed, and perhaps a little bit of chasing that is going on. I mean, the reality is, if you look at the landscape, clearly it is an evolving landscape. Only 2 countries have legalized the recreational use of cannabis: Uruguay and then most recently Canada in 2018. There's still a couple of dozen countries or so that now permit medical consumption of the plant. Certainly here in the U.S., it gets way more complicated because a number of states have legalized it for medical use, like here in Florida, and other states, 10 of them, as a matter of fact, permit it for both medical use and recreational use. So when you look at the landscape of pot here in this country, it really is a checkerboard. There are some states that don't allow it at all, some states that allow it for medical, some states that allow it for both recreation and medical use. And that's a pretty dramatic difference when you look at kind of the patchwork nature here in the U.S. What's interesting is it's mostly high population areas that actually have passed usage of marijuana. About 2/3 of the population in the U.S. has access to medical marijuana, and 1/5 of the population has access to recreational marijuana. It's hard. The reality, of course, is that when you look at it, this type of conversation, when we have something new bursting on the scene, it can really lend itself to a lot of storytelling and a lot of speculation and a lot of overreaction to what the real story is. When you even start to look at some of what has happened so far, if you take a state like Washington, which is a very early adopter state, the reality is that cannabis prices have steadily declined since it was made available. And a lot of that, according to some of the research that's been done on it, is that it's hard to be in a category where there's little product differentiation and really no pricing power, if you will. I mean, it's basically a pure supply and demand and no real differentiation among the products. So that's why, if you look at some of these early adopter states where the cannabis price has steadily gone down, and so that's simply a reflection of the fact that there really isn't any product differentiation here in this landscape. And from an investing perspective, those are the kinds of things that you want to look for, right? I mean, you want to find a company or a business that has the ability to really differentiate their product, to really have some level of pricing power. If you think Apple and iPhones, I mean, that was the only game in town. And so Apple was able to price their iPhone at a very high price point and make a tremendous amount of profit, particularly on it in the early years. You would have to really question whether that's possible in the cannabis market. It is a plant, and there's not really a whole lot of differentiation, and very difficult to have pricing power on the part of the producer. And certainly some of the early data coming in from some of the early adopter states, like the state of Washington, suggests that the price is continuing to steadily decline. And so the question is, when you really want to look for an opportunity that's a unique opportunity, does cannabis really fit that bill of what you would say to be a unique opportunity? And unfortunately, in our view, based upon the lack of product differentiation and the lack of pricing power on the producer side of it, it's very hard to see where that story is ultimately going to play out, where you're going to have the Apple of the cannabis world anytime in the future. It really is a product that really does not have any differentiation. And so if you're thinking of it from an investing perspective, I would encourage you to kind of seek out something that had more of a product differentiation with some intellectual property associated with it. It's a plant, so it doesn't really have intellectual property associated with it, like an iPhone, and the ability to have it and price it in a different way. I think those are the things to really think about, just purely from an investing perspective, which really serves to poke some holes in the pot story, is that you don't see those aspects in the cannabis market that would allow there to be a differentiator for any one particular company over the other. It seems to us that at the end of the day, the big beverage makers, the liquor guys, the beer guys are certainly in that industry, and ultimately, I think that a lot of that will become part of the liquor and beer market, but ultimately that's not a whole lot of a story about differentiation or pricing power. So we would urge a lot of caution on that. If you want to, if you like doing your own research, we would encourage you to look for products that have a pricing differential, that have the power to be able to generate a differentiation from its competitors. And I'm not sure that exists in the cannabis market. Time will tell, that's for sure, but be careful of anything that has a lot of stories to it, a lot of excitement. Oftentimes that excitement is short-lived at best. With that, we will wrap it up and get on out of here. Thank you all for listening. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.